Money is not wealth. It is a system for measuring and moving value. Once you understand that, banks, inflation, and currency start to make sense. Let's start at the beginning. Imagine a village with no money. People trade directly. Rice for fish, shoes for tomatoes. This is called barter. The problem is obvious. Trade only works when both people want what the other has at the same time. Economies cannot grow like this. So, societies created money as a shared agreement of value. Money became three things: a medium of exchange, a store of value, and a unit of account. Originally, money was tied to physical scarcity: gold, silver, salt, or cowries. These worked because they were hard to fake and limited in supply, but carrying gold everywhere was dangerous and inconvenient. This is where banks entered the story. Goldsmiths and early banks offered to store people's gold safely. In return, they gave deposit receipts. Over time, people began trading the receipts instead of the gold itself, because everyone trusted they could redeem them later. Then something important happened. Banks realized most people never withdrew all their gold at once, so they began lending out some of the stored gold while still issuing receipts. This created fractional reserve banking, the foundation of modern banking. This is the moment money changed forever. Banks were no longer just storing money. They were creating it. Today, when you deposit money in a bank, the bank keeps only a small percentage as reserves and lends out the rest. That loan becomes someone else's deposit, which can be loaned again. This multiplies money inside the economy. This is why most money today is not physical cash. It is numbers in bank databases. Now, let's talk about currency. A currency is simply the official money system of a country, usually managed by a central bank. The central bank controls how much money exists in the system and how easily banks can lend. Modern currencies are called fiat money, which means they are not backed by gold or any physical asset. They are backed by trust in the government and the economy. The value of money now depends on economic productivity, government stability, and supply versus demand. This brings us to inflation. Inflation happens when the amount of money grows faster than the amount of goods and services in the economy. When more money chases the same number of products, prices rise. Think of it like this. If a village has 100 loaves of bread and $100, each loaf costs about $1. If the money supply increases to $200, but bread stays at 100 loaves, each loaf now costs about $2. The bread didn't change. The money lost value. Central banks often increase the money supply during crises to stimulate spending and prevent economic collapse. This can help in the short term, but risks inflation if done excessively. This is why inflation quietly reduces purchasing power over time. Your money buys less even if the number in your bank account stays the same. Banks profit mainly through interest, the cost of borrowing money they created through lending. Central banks influence interest rates to control economic activity. Low interest rates encourage borrowing and spending. High interest rates slow the economy and reduce inflation. If you've been enjoying the content and learning something new here, I'd really appreciate your support. Creating these videos takes time, research, and energy, and we've got even bigger and better content coming. Deep dives, clearer explanations, and more practical knowledge you can actually use. If you'd like to support the channel, you can buy me a coffee by clicking the link in our TikTok bio. Think of it as helping fuel the work that goes into these videos. There's no pressure at all, and you can give any amount you want. Every bit of support helps keep this channel growing and improving. And if you can't support financially, sharing the videos and engaging with the content already means a lot. Thank you for being here and being part of this journey. So, the system looks like this. Central banks manage currency supply. Commercial banks create money through lending. Governments spend and tax within the system. People work, borrow, save, and spend inside it. Money flows in cycles. The key insight is this. Modern money is not valuable because it is scarce like gold. It is valuable because people collectively believe in the system that manages it. Once trust breaks, currencies collapse. History shows this repeatedly, from the Roman Empire to Zimbabwe to Venezuela. Understanding money is really about understanding confidence, debt, and control of supply. The people who understand this system don't just earn money, they learn how to position themselves where money flows.